Hello there, students of economics. Welcome to yet another teaching module in economics titled Income Determination. Let's learn something new today. So let me take you on. Having learned about the concepts of GDP, that is gross domestic product, and national income when we studied the chapter National Income Accounting, we are in a better position to be able to explain or understand the meaning of the concept of aggregate demand. What is aggregate demand? Aggregate demand refers to the sum total of expenditure on domestically produced goods and services during the period of an accounting year. Well, we are familiar when we learned the expenditure method of calculating national income. What did we do? We summed up all the expenditures that would take place in the economy, expenditures that came from the side of private individuals and households, expenditures of the government, expenditures of business enterprises, as well as the net exports. You remember that? Well, this is very similar to that concept. Aggregate demand is equal to C plus I plus G plus X minus M. This is put in the form of a formula. Well, it's broken up and told to you what each of those alphabets denote. So AD stands for aggregate demand, C stands for consumption, I stands for investment spending by businesses, G stands for government spending or government expenditure, X stands for exports revenue, M stands for spending on imports. Let us now study the components of aggregate demand. The first one being private consumption expenditure, denoted by the symbol C. What does it comprise of? It comprises of demand for all goods and services by households of a country during an accounting year. Higher the level of personal disposable income, higher the private consumption expenditure, and lower the level of personal disposable income, lower is the private consumption expenditure. So basically, this component depends on the level of income. The second component of aggregate demand is private investment expenditure. What does it refer to? It refers to expenditure by private investors or businesses or business enterprises on the purchase of goods which add to their stock of capital. If the rate of interest is high, the investment expenditure is low, and vice versa will also be true. That is, if the rate of interest is low, the investment expenditure is high. So you see, this component of aggregate demand depends more on the rate of interest. Let us understand the third component of aggregate demand, and that is government expenditure. What does it include? It includes both government consumption expenditure as well as government investment expenditure. Basically, government investment expenditure is generally autonomous investment determined by considerations of social welfare. So autonomous investment would mean the investment that is necessary for the society to bring about social welfare. Then we have the third component of aggregate demand, that is net exports. How do we find net exports? We subtract the value of imports from the value of exports to derive net exports. Well, let's break it up and understand better. Exports are expenditures by foreigners on domestically produced goods or our goods produced by our country. And what are imports? Imports refer to demand by our residents for goods that are produced abroad by foreigners or the rest of the world. Well, expenditures by the foreigners on domestically produced goods, that is our goods, has to be added to total expenditure, while expenditure on imports that we pay to the foreigners for the goods that we import has to be subtracted. Thus, X minus M is added to aggregate demand. Moving on to the next concept, which is aggregate supply. What does aggregate supply refer to? It refers to the flow of goods and services as planned by the producers during an accounting year. It is identical with the flow of income during an accounting year. So we know that the accounting year starts from 1st of April of one year to the 31st of March of the next year. So whatever pans out during this period in the economy in terms of production of goods and services is valued or is included in the value of national income, which is the same as aggregate supply. Moving on to study the components of aggregate supply. What are the components of aggregate supply? There are two components, consumption and savings. Consumption denoted by the letter C, savings denoted by the letter S. Consumption as a component of income is always positive because there is always some minimum level of consumption even when income denoted by Y is zero. That means even if nothing is being earned in the economy, there will always be some level of consumption. And therefore, consumption increases as income increases. Going on to savings. Saving as a component of income may be negative. When will savings be negative? Suppose there is no income earned. There will be some level of consumption. Where do you think that is taken from? That will be taken from savings. So therefore, savings may become negative. That happens when the level of income is low or if there is no income. But savings increases when income increases. So both consumption and savings do depend on income. We have studied what is the production function, demand function, supply function, and we know, for example, in the case of production function, it is the functional relationship between material and non-material inputs and outputs. So also, in the case of consumption function, we know that there is a relationship between consumption and income. So that is a relationship we are studying here. Let's define it or understand it better. The amount of money spent by people on purchase of goods and services to satisfy their needs directly is called consumption expenditure. We know that. Well, this mainly depends on income, obviously. And as income increases, consumption also increases. However, there is some level of consumption irrespective of the level of income. I want you to note that the rate at which consumption increases is less than the rate at which income increases. You see here from 0 to 60, income has increased by 60 units. However, consumption has increased from 20 to 70, which means it has increased by 50 units. Further on, when income increases from 60 to 120 units, consumption increases from 70 to 120 units, which is again less than the increase in income. Having said that, let us now define what is the consumption function. As I told you earlier, the rate of increase in consumption is less than the rate of increase in income because after a certain level of income is reached, people start saving a part of their income. This behavior of consumption with respect to income is called as consumption function. So we have seen The behavior of consumption with respect to income is called consumption function. Now let's move on to study what is the supply function. Well, savings is the excess of income over consumption. For example, at this level, we know that income is more than consumption. So there is an excess of income over consumption. What is that excess? How is it given by? 180 minus 170 is equal to 10. So what is savings therefore? It is the excess of income over consumption, that is C. Since income is equal to consumption plus savings, if we want to express the value of savings, we only have to take consumption the other side, and so we get savings equals to income minus consumption. Like consumption, savings is also directly related to income. Savings also increases as income increases. You can see here, as income increases from 120 to 180, from 180 to 240 and so on, we can see that savings also rises from 0 to 10 to 20 and so on. Since there is always some minimum level of consumption even when income is 0. See here, even when income is 0, there is always some minimum level of consumption. That means that savings must be negative. If we use the formula S equals to Y minus C, obviously 0 minus 20 and negative 20 is the sign of the bigger number. So the answer is negative 20. So that means savings must be negative as long as consumption is greater than income. See here, when consumption is greater than income, savings is negative. Here as well, consumption is 70 and income is 60. And so savings is negative 10. So as long as consumption is greater than income, savings will be negative. When will savings be equal to 0? When income is equal to consumption. See, you can see here in the table, 120 is equal to 120. So therefore we say at break-even point, that is when consumption is equal to income, savings is equal to 0. This behavior of savings with respect to income is called savings function. Having learned the concepts of aggregate demand and aggregate supply, we are now in a position to be able to understand a new concept, and that is excess demand. So obviously it means that demand is more than supply. Let us define it properly. Excess demand refers to a situation when aggregate demand is excess of aggregate supply. In other words, aggregate demand is more than aggregate supply. But at what level? Corresponding to full employment in the economy. So this clearly tells us that aggregate demand is greater than aggregate supply. Well, the desired aggregate demand in the economy exceeds its full employment level since resources have already been fully employed. Let me show you here. The aggregate demand curve denoted by the red line is the one that we desire, that coincides with aggregate supply, intersects with aggregate supply at full employment of all resources, maybe labor, for example. But the actual aggregate demand has gone way ahead, above full employment level. We have attained full employment here, but as you can see, the new aggregate demand curve, the actual demand curve, has gone forward ahead and intersected the aggregate supply curve beyond full employment, which means that we are in excess situation. Aggregate demand has gone way ahead than the desired level. So aggregate supply can be raised, but demand only means greater pressure on the available goods and services. So you can see, since the demand is more than the desired level, there is a pressure on the prices, and so prices tend to rise. So we see here there is an inflationary gap. Well, all you need to understand and know and define is what is excess demand. It refers to a situation when aggregate demand is excess, more than, greater than, of aggregate supply corresponding to full employment in the economy. As opposed to excess demand, we have the other situation, which is deficient demand. So what is deficient demand? It refers to the situation when aggregate demand is short of or less than. Short of what? Short of aggregate supply corresponding to full employment in the economy. So ED in this case is short of full employment level. So the desired ED does not permit production at full employment level. Aggregate supply being perfectly elastic will match with aggregate demand at a level lower than full employment in the economy, so that there is underemployment equilibrium in the economy. So you see here what is desired is denoted by the red aggregate demand curve, and the dotted line indicates what actually has happened in the economy at this point. Before reaching full employment of resources or full employment level, equilibrium is reached before that level. So you have aggregate demand being less than aggregate supply related to this particular level, that is level of full employment of resources. So since aggregate demand is less than aggregate supply corresponding to the level of full employment, it is here, which is less than full employment. Therefore, we say that there is deficient demand. And when there is deficient demand, there will be lower prices, which we call as deflation. What you need to know from the examination point of view is what is deficient demand. It refers to the situation when aggregate demand is short of aggregate supply but corresponding to full employment in the economy, relating to full employment in the economy. Now let's study what is the meaning of fiscal policy. Fiscal policy refers to the budgetary policy of the government, that is the policy related to revenue and expenditure. How does the government earn revenue? We have studied under government budget. The government earns revenue through tax and non-tax sources. And we know that the government spends by way of subsidies and other expenditures of the government. Well, this policy relating to revenue and expenditure of the government, which is used to correct either excess or deficient demand that we just studied in the economy. Let us define it again. Fiscal policy refers to the budgetary policy of the government, that is policy related to revenue and expenditure of the government, which is used to correct either excess or deficient demand in the economy. So both excess and deficient demand are situations of disequilibrium. They need to be corrected. And how will they be corrected? With the fiscal policy enforced by the government. That brings us to study the measures that are needed to control excess demand. The first measure to control excess demand in the economy would be government expenditure. But how do we use this tool of government expenditure? The government spends money on public work programs, like construction of roads, bridges, infrastructure development, in other words, as well as on education, social welfare, defense, subsidies, and so on. When there is excess demand, do you think the government should increase their expenditure? There is already excess demand situation in the economy. What should the government do? The government should reduce their spending. So therefore, when there is excess demand, government expenditure is reduced. The next tool would be taxes. Let's see how the government will use taxes to control or reduce excess demand situation in the economy. When there is excess demand, the government increases the tax burden on households and producers in order to reduce the aggregate demand. Why is this done? This is done to reduce the cash or purchasing power in the hands of the people. So if there is excess demand, that means people have excess purchasing power. How do we reduce that? Simply by increasing the taxes. Here is another tool used by the government to control excess demand, and that is public borrowing or public debt. When there is excess demand, the government increases public borrowing. How does the government borrow from the public? By issuing bonds. The government may sell bonds, securities, treasury bills in the open market. And so when the government sells bonds, for example, what will happen? The cash reserves that are in the hands of the public will come into the coffers of the government. So the government will have succeeded in reducing the purchasing power by selling bonds. In other words, by public borrowing. So therefore, when there is excess demand, the government increases public borrowing or public debt to reduce the cash in the hands of the people and to decrease aggregate demand. The next tool used by the government to control excess demand is deficit financing. What is deficit financing? It means borrowing by the government from the RBI or the central bank. The RBI lends money to the government by issuing more currency. When there is excess demand, do you think the government needs to borrow from the RBI? There is already excess purchasing power in the economy. Already the aggregate demand is over and above aggregate supply. So there is no need for the government to borrow from the RBI. So the government will reduce borrowing from the RBI when there is excess demand. They will avoid deficit financing. What are the measures to control deficient demand? Now the same tools, government expenditure, taxes, public borrowing and deficit financing are used here, but in a different way. Let us see how. How will the government use the tool of government expenditure when there is deficient demand, when aggregate demand is less than aggregate supply? We know that the government spends money on public work programs, infrastructure, education, social welfare, defense and subsidies. And when there is a situation of deficient demand and aggregate demand is less than aggregate supply, well, the government will have to come in and increase the government spending. So when there is deficient demand, government expenditure will have to be increased. Let's see how the government uses taxes to control deficient demand. You know, when aggregate demand is less than aggregate supply, it means purchasing power of the people is already less. So what is the point of increasing taxes? What should be done? When there is deficient demand, the government reduces the tax burden on households and producers. Why? In order to increase the aggregate demand. This gives people more cash in hand to spend. It increases their purchasing power and thereby there will be an upward push on the aggregate demand. And aggregate demand will be equal to aggregate supply. Now let's see how public borrowing or public debt is used to control deficient demand. In a situation of deficient demand, the government will reduce public borrowing. Do you think that the government should sell bonds to people? No. Now they should be buying bonds from people. Because when the government buys the bonds from the people, for example, the people's purchasing power will increase. The cash in the people's hands will increase. Because when the government buys, the government will pay them in terms of cash. Right? So in this case, the government will reduce public debt. And how do they do that? By purchasing government bonds, treasury bills, securities and so on in the open market. And in this way, the aggregate demand can be increased. What do you think will be done in times of deficient demand where deficit financing is concerned? We know that the RBI lends money to the government by issuing more currency. But when there is deficient demand, the government will need the money from the RBI because they want to spend money on behalf of the people because people's purchasing power is less. So the government will need to borrow from the RBI. When there is deficient demand, the government uses deficit financing to increase aggregate demand. The government will increase the borrowings from the RBI. So let's sum up the measures to control excess demand: decrease in government spending, increase in taxes, increase in public borrowing or public debt, decrease in deficit financing. Let's see the measures to control in case of deficient demand. Opposite: increase in government spending, decrease in taxes, decrease in public debt, and increase in deficit financing. This brings us to the end of the chapter Income Determination and this teaching module. I would urge you to have a better understanding of the topic, to view the video again and use this video every time you need to revise the topic so that you are thorough with all your concepts and you are going to nail the exams. Thank you for giving me a listening ear.